Excellent. It's my absolute pleasure to welcome you today to the 2023 year in review. It's our reflections at sennder and the outlook for the year to come. It's the second time we're doing this, and it's my pleasure to welcome you today. Before diving right into it, I suggest we quickly look at the agenda. And sennder has released its look back on 2023, which contains a perspective on several of the key themes of last year, how they've impacted shippers and carriers in the road freight industry, and what to look out for in 2024. Today, we'll touch on the main sections of the report, starting with the market overview. But before we go there, let's quickly look at today's speakers. I'm not here by myself as one of the co-founders and managing directors of sennder, but I brought two colleagues along. Why don't you quickly introduce yourselves, starting with Tom?
Thank you, Julius. So I'm Tom Matthews. I lead our industry insights within the strategy and planning team, and also joined by Sangita.
Yes, hi, I'm Sangita Sharma, and I'm also at sennder as the Director of Strategy, Planning, and Pricing. So lots of interesting topics today on all of that.
Excellent. Thanks for the very quick introductions. Now, jumping into the market overview and starting with the cost evolution specifically, 2023 was a challenging year for logistics providers, as global macroeconomic conditions saw a reduction in the demand for road freight specifically. After a record-breaking road freight year that we had seen in mid-2022, sennder noted a decrease in freight rates, which continued into sort of the first Q1 of 2023. This decline was contributed to an oversupply of capacity, specifically in February and March, with available truckload capacity up over 20% versus the previous year. Now, the surge in capacity exerted downward pressure on freight rates as carriers engaged in a pricing competition to secure loads on the market. Now, difficult global economic conditions saw a fairly slack freight market persist throughout the mid-year with lower shipper demand for truckload volumes overall. However, in the latter month, escalating fuel and toll costs, which we'll dive into in a second, raised carrier cost basis, resulting carrier rates finishing slightly ahead over the year. Now, note that December rates are only 1% above January rates. January typically is a loose market, whereas December is peak demand, and only 1% decrease shows softness of freight demand over last year. Now, moving on and looking at the spot opportunities on the market. Now, spot market transactions satisfy one-time immediate shipping needs and so serve as a key gauge for the overall road freight market and its performance. Now, following a decline in the second half of 2022, road freight demand remained subdued throughout 2023, with a total spot opportunities down 47% year over year. Spot opportunities remained relatively stable over the year. Unfavorable macroeconomic conditions suppressed customer spending and business orders, leading to a sustained excess truckload capacity. Throughout the year, contracted load rejection rates were low, with carriers fulfilling contracted loads in the absence of more lucrative spot opportunities. Low rejection rates further limited spot activity, as carrier rejections result in spot transactions for shippers needing to place loads at a short notice. In December 2023, spot opportunities were down by 5% year over year, and spot prices increased with the introduction of German toll hikes and heightened demand during peak season. Anticipated toll increases in Hungary, Austria, and the Czech Republic specifically are expected to drive further spot rate increases in 2024. Now, let's look at the corridor performance. Now, our regional cost per kilometer index tracks the development of sennder carrier costs based in the sennder network of over 40,000 trucks across Europe, showing the regional variation in cost development during the year. Starting with the German domestic market. The German domestic market is a key market for sennder, which saw a spike in carrier costs in December due to the increase in German road tolls, with freight rates finishing the year up over 6%. This increase to carrier cost basis outweighed the drop in demand caused by lower economic activity as the German economy fell into recession amid a manufacturing downturn. Looking at the second corridor, the German-Poland corridors are critical to the European road freight market, connecting a major carrier base in Poland to the largest economy of Germany. Early in the year, decreasing load numbers saw intensifying prices competition between carriers as carrier overheads make it preferable to run loads at a slight loss than to have trucks sitting on idle. At the same time, rising fuel costs were seen in the first in Germany in Q3, while the Poland diesel price remained flat before spiking 19% following the national elections in October. Recovery of Germany or of German load volumes as the economy exists recession this year. Recovery of German load volumes as the economy exits recession this year, and the influence of higher toll costs will guide the development of carrier rates along these lanes in 2024. Freight rates on the Spain to Netherlands corridor finished the year relatively flat. The carrier cost variation seen throughout the year is driven by recurring seasonal dynamics. The seasonality of the Spanish agricultural sector causes rate fluctuations. The Spanish net truckload imports versus export balance swings significantly during the harvest seasons. Now, more truckloads carrying fruit and vegetables leaving the country than re-entering. The spike in inbound demand for the beginning of the harvest season in early November is seen in the Spain to Netherlands rate development. Now, let's look at one of the key themes of 2023, and I'll pass over to Tom to guide us through the fuel prices.
Thank you, Julius. So one of the key themes covered by our report this year is the fuel price development during the year. And there's a clear importance of fuel prices within our industry, as we see here the cost breakdown for EU carriers across the last quarter of the year. We see fuel costs formed a major component around a quarter of carriers' total cost base. And so fuel price volatility remains a key risk that our carriers deal with. To avoid exposure risk to fuel price movements, many carriers enter into fuel surcharge agreements with shippers, and this allows them to adjust for price variations between the contract date and time of transport. Carriers without a fuel surcharge agreement in place may have relationships with shippers where they can renegotiate terms as prices move around. But in a year, such as last year, where capacity outweighed load demand, we heard of a number of carriers in this position having to wear the costs themselves rather than attempting to renegotiate prices in a slack freight market. Looking now at oil price development, and in Europe, the Brent crude oil price is our key benchmark, as Brent oil is the primary input refined into our diesel. We saw Brent oil prices remaining well below the peaks, which were seen in 2022, following the sanctions of Russian oil imports by the EU, US, and further afield. Last year, global oil markets were much more stable, with the EU having successfully rebalanced the majority of its oil import mix away from Russia, and global production adjusted to the new state of play. Now, we did see oil prices spiking in the second half of the year, as the OPEC Plus nations announced production cuts of over 1 million barrels per day onward, with the aim of driving up prices. And these cuts did have the intended effect for a while, causing a 25% price increase between May and September as oil supplies tightened. Further concerns over supply disruption surrounding the unrest in the Middle East drove prices up further in October, but this price momentum ultimately wasn't satisfied, as lower forecast demand due to decreased consumption in major oil importing countries like China and the US saw prices settle to around $80 per barrel at year end. Taking a look now to the supply side and oil investment and production, and 2023 was another year of growth in upstream oil investment after spending had declined in recent years amid growing ESG pressures. The price spike seen in 2022 motivated non-OPEC plus countries to speed up their own investment and production activity, and annual investment is estimated to have grown over $200 billion in the last 2 years. This increased activity saw US oil production up 8.5% in 2023 to all-time high production levels, and production is also up in countries including Canada and Brazil. OPEC Plus have since upped their output cuts to over 2 million barrels per day for the first quarter of this year, but whether or not all member states adhere to these cuts is another question, as given production cuts failed to effectively sustain raised prices last quarter, some may question the merits of cutting production without seeing any price benefit. Looking ahead to the rest of the year, and the ability of OPEC countries to remain disciplined and adhere to their production cuts will be central to oil price movements amid shrinking market shares and increasing volumes from non-OPEC nations. We may also expect oil prices to climb as global economies continue their recovery from slowdowns and overall consumption increases. Turning now to some of the key factors we saw impacting our carrier base last year. And driver shortages in our industry are well documented, with an aging population and a shortage of new drivers in the pipeline remaining a concern. The EU is particularly stretched, with a third of the driver base aged 55 years and above, and facing retirement in the next 10 to 15 years. At the other end, only 5% of drivers are currently aged under 25. We've been seeing increasing initiatives within our carrier network to try and expand the intake of drivers beyond the EU, with a number having programs in place for recruitment, training, and supporting drivers in getting accredited, as well as some carriers who are offering referral programs for international drivers to refer colleagues from back home. It's an issue that remains to be solved, and one where we're seeing carriers getting increasingly creative to widen driver pools and entice new entrants into the profession. Looking next at truck production, and we saw a 16% increase in new truck registrations in the EU last year, as semiconductor chip shortages seen after the pandemic were largely resolved. We've also seen vehicle manufacturers building more direct relationships with chip companies, allowing for greater prediction of availability and better alignment with automotive production schedules. This ongoing supply of modern trucks is needed to avoid disruptions to key shipping lanes and is integral in providing more budget-friendly rates for shippers in the years ahead. Last year, we also saw some large-scale industrial action as Polish truck drivers began to strike in protest of the unrestricted access granted to Ukrainian drivers entering the EU. As part of the reliefs granted to the Ukraine, the EU suspended a daily permit system limiting the number of trucks permitted to enter the EU. Polish drivers argue that this relief is causing unfair competition, as Ukrainian drivers have flooded shipping lanes and are undercutting their prices. From November, Polish drivers blockaded a number of border crossings with Ukraine, disrupting trucks carrying commercial goods, but also holding up deliveries of military and humanitarian supplies. The blockade was suspended from mid-January, pending an agreement between the drivers and the Polish government being reached by the beginning of March. Drivers are calling for the reintroduction of a daily permit, capping the numbers of Ukrainian drivers allowed to enter, as well as seeking financial relief for losses suffered. And they want the blockade can be reinstated at any time if a satisfactory deal isn't reached. This activity captures two different blows to driver availability here in the EU, both in the Ukrainian drivers who left EU carrier bases to return home at the start of war, as well as Polish drivers who aren't working while protesting. Last year, there was an excess of truckload supply with more drivers than loads, but if capacity tightens, driver protests such as this will put pressure not only on governments, but also on freight rates as available driver pools are reduced. So we'll continue to watch this situation with interest and see whether a lasting deal can be struck. Hand over to Sangita now to discuss some of the key macroeconomic factors that affected the freight market last year.
Thanks, Tom. Yeah, so when we look at the macroeconomy, obviously we need to look at inflation rates. So if we take a look at how the inflation rates progressed since 2022 into 2023, unfortunately, it's not a new topic because the inflation impact in 2022 was quite hefty on most of the markets in the EU. And then several countries started the year in double-digit inflation rates, and then that remains to be so in most of the countries due to the announcements that happened during the first 6 meetings of the year with the ECB, or the European Central Bank. As we know, higher inflation rates and therefore higher interest rates lead to reduced business investments and generally less consumer spending as households focus on savings and mortgage expenses, etc. So therefore, we saw softer demand and we saw lower order volumes, and there were a lot of predictions of a recession occurring. The softer demand put price pressure on the carrier market, and we unfortunately also saw many smaller carrier businesses close, as Tom alluded to, in this tough market. And we continue to also see this race to the bottom in pricing near the end of the year as well. So as shippers, were looking to also cut costs on their side to compensate for the reduced demand, there's also more competitive pricing in tendering and RFP processes as we reach the end of the year as well. But I think it's also really interesting to look at the GDP growth country to country in the EU from the previous year. So as we look at 2023, and you look at this graphic on the left, as you go from left to right, you are looking at kind of a north to south progression geographically. And you'll see that there's generally a trend where the southern countries have actually stronger GDP growth than our northern countries, and as well as our bigger markets. So the size of the bubble demonstrates the size of the country's GDP impact. And so you'll see that, the largest economy in the EU, which is Germany, had a contraction over the year, and that impacts about 20% of the Eurozone GDP. And so therefore, the Eurozone GDP over the course of 2023 grew, a measly 7.7% over the year. And that's down significantly from the 2022 growth, which was 3.3%. When we're looking at the outlook for 2024, the IMF is forecasting a 1.2% GDP growth in the Eurozone for 2024. And that means, at least we're now moving away from recession predictions, but the growth is quite steady and stagnant. And that compares to about a 1.4% average growth over the last 10 years. When we look at the outlook in other countries, sorry, to go back to the previous slide. Okay, when we're looking at outlook in other countries, such as the United States, we saw really strong GDP growth at the end of 2024. And so this is an interesting divergence that is occurring between the Eurozone and the US, as it seems to be that the demand and the cooling inflation rates are having positive impact on demand. We're not necessarily seeing the same impact in the Eurozone, and that could be due to many uncertainties that are occurring in the Eurozone, including the wars and the impact of tensions in the Middle East. Now, looking at the Eurovignette, and the impact on and CO2 emissions and tolling, a hot topic of this past year that's going to only continue to influence us in the coming year. So for those that are unfamiliar with the directive, the Eurovignette directive, countries are able to apply a CO2-based road toll on certain vehicle types and emission classes. And the most significant impact of this has come from Germany, which implemented a substantial emissions tax, raising the road toll costs up by 83% for heavy vehicles, with the only exception being made for zero-emission vehicles. So as you can imagine, that impacts almost, the large majority of the vehicles that, go through Germany. And so this began in December. And the impact was, as I said, up 83%. But the thing is, we're going to continue to see impact in other countries as well. So other EU countries are preparing to increase tolls, maybe not to the same scale as Germany, but that at the start of the year, we already see Austria with increases around 20 to 30%. And in the Czech Republic, we're seeing increases around 10 to 15%. So when you look at the graphic on the right, you can kind of see how the carrier costs are impacted by this, and the greatest increase in the past year has come from the toll cost independently. So what will be interesting to see is over time where that where that cost gets passed on to, because sometimes that's absorbed by the carrier, and sometimes the carriers try to charge the shipper and include that into surcharges, and then that eventually gets also passed down to the consumer. So it's always interesting to see where these costs gets passed on to, but we will continue to see these increased tolls on high emission vehicles or non-zero emission vehicles, and that is driving a pretty strong force towards green demand, and that is indeed what we are seeing at sennder as well. So on the next slide, we are seeing that the European Parliament is intensifying the emission reduction targets on heavy vehicles, and so the progression, as you can see on the left, is 45% reduction by 2030, all the way to 90% reduction by 2040. So this is really pushing green demand. And when we look at there's multiple ways to push for the zero emissions. There's the biofuels, but there's also EV vehicles, which are also considered zero emission. And I think what's interesting is right now, if you look at the adoption of electric trucks or electric vehicle trucks, we're actually where electric vehicle cars were about 6 to 7 years ago. So we're around 1.2% adoption of electric vehicle trucks right now, and that's about where we were with cars about 6 to 7 years ago. But then you saw as there were more incentives pushing for this, we saw a big spike in demand over the last few years, and so we think we're in a similar place with EV trucks, that in 5 to 6 years we'll also see a large demand for EV trucks as well. And so, from our sennder experience, we saw a 6-fold year-over-year increase in demand for green transport. And, we've begun an initiative called Juna, where we are trying to promote adoption of EV trucks. And we are also seeing, some traction with that. And I don't know, Julius, if you want to add any color to that, but I think that's been an interesting depiction of demand for green.
Excellent. Thanks for the insights, Sangita, as well as Tom. And as Sangita had just mentioned, the Project Juna is something that's very dear to me. It's a joint venture between sennder and Scania that we've kicked off in the year of 2023 in order to make electric trucks more accessible to our carriers as well as to our shippers. Now, sender's ability to provide green truckload service to our shippers remains a differentiating factor in the overall market, and it's an increasingly significant portion of our business. In fact, 18 or over 18% of all loads in December of 2023 were operated with a green component. Now, total tons of carbon emissions prevented by sennder green loads during 2023 was so significant that it was on par with taking over 3,100 cars off the road. Now, that today was only a very brief summary of the full report, where we'll go into more detail into what we've discussed today, as well as other topics. Looking at the other topics, 3 particular callouts for what we've omitted from today's presentation is first an overall barometer, an overview of the key drivers of supply and demand in the road freight industry. Second is the peak season and analysis of the annual surge in volume driven by Black Friday as well as Christmas, and particularly in the retail vertical. And then lastly, the Russian and Ukraine conflict and the ongoing effects of the war, which continued to be felt 2 years on from the Russian invasion. So be sure to check it out. It was my absolute pleasure today to host this session, and a big shout out to Sangita as well as Tom and your teams for dedicating so much time into preparing this. And I look very much forward to a successful year of 2024, and then deep diving into the market again in early 2025 for our next annual review.